Sarah clicks Halt Submit on her student loan payment and exhales. She just sent an extra $500 to the bank, chipping away at the principal. It feels responsible. It feels safe. It feels like she is finally taking control of her life. David clicks Buy on his brokerage account. He just sent that same $500 into an S&P 500 index fund, leaving his student loans exactly where they are. He feels smart. He feels like an investor. He feels like he is building wealth. They both think they are making the right choice. They both feel financially responsible. But 20 years from now, one of them will be quietly sitting on an extra $100,000, while the other wonders why they worked so hard just to break even. At first, the math looks obvious, but the real cost does not show up at the beginning. Let's keep this fair. Sarah and David both earn the exact same salary. They both live in the same city, and they both graduated with exactly $50,000 in student loan debt at a 6% interest rate. After paying their rent, buying groceries, and covering their minimum loan payments, they each have an extra $500 left over at the end of every month. The only difference is what they do with it. Sarah hates debt. The idea of owing money to a bank makes her stomach tight. She wants the loans gone. So every single month, she takes that extra $500 and aggressively pays down her student loans. Her goal is simple: get to zero as fast as humanly possible. David looks at the numbers differently. He makes his minimum loan payments, but he refuses to give the bank a single extra dollar. Instead, he takes his $500 and automatically invests it into the stock market, aiming for the historical average return of around 8 to 10%. Sarah is buying freedom today. David is buying assets for tomorrow. On paper, they both look smart, but the gap between them is already starting to open. Let's check the scoreboard at the end of year 3. Sarah has been relentlessly throwing her extra $500 at her debt every month. She has paid down a massive chunk of her principal. Her $50,000 loan is now sitting at just over $22,000. She logs into her account, sees that shrinking balance, and feels a rush of relief. The finish line is in sight. David is playing a different game. His student loan balance is still hovering around $42,000 because he is only making the minimum payments. But he logs into his brokerage account and sees that his investments have grown. Between his contributions and market growth, his portfolio is now worth about $21,000. If they stopped right here, Sarah feels like the winner. Her net worth is actually slightly higher because she avoided thousands of dollars in guaranteed interest charges. Plus, her stress is lower. She doesn't have to worry about the stock market crashing. She doesn't have to watch the news and panic. Every dollar she pays down is a guaranteed 6% return. David, on the other hand, is watching his portfolio bounce up and down. Some months he makes money. Some months he loses it. His debt is still a heavy anchor, and his investments haven't had enough time to truly explode. At year 3, paying off debt looks like the smarter, safer, and faster way to build wealth. But this looks like the smart move until year 5. Year 5 is where the story changes. This is the part most people never calculate. By year 5, Sarah makes her final payment. The screen flashes 0. She is completely debt-free. She throws a little party, cuts up her loan documents, and finally feels the weight lift off her shoulders. She now has her full income to herself, and she can finally start investing that extra $500. But let's look at David. David is still making loan payments. He will be making those payments for another 5 years, but his investment account has been quietly working in the background. Because of compound interest, his portfolio is now crossing $40,000. Here is the secret of the math that Wall Street understands, but most people ignore: the 6% rule. When you pay off debt, you get a guaranteed return equal to your interest rate. For Sarah, paying off her loans gave her a guaranteed 6% return. That is solid. But the stock market, over long periods, historically, returns around 10% before inflation. For the first few years, that 4% difference, the gap between a 6% loan and a 10% investment, feels tiny. It feels like pennies. It is not enough to justify the stress of carrying debt. But right around year 5, the math flips. David's money is now making its own money. His investments are generating returns, and those returns are generating more returns. Sarah is just starting from 0. She has no debt, but she also has no assets. The first few years told one story, the next few years tell another, and the gap between them is about to explode. Before we look at the final scoreboard, we have to talk about the hidden cost of David's strategy. Because if I only showed you the math, I wouldn't be giving you the full picture. The math says David is winning, but David is paying a hidden tax that does not show up on a spreadsheet. Cognitive load. Debt is not just a number, it is a psychological weight. Research shows that carrying debt increases stress, anxiety, and even physical health problems. Every time David wants to take a vacation, change jobs, or take a risk, he has to think about that monthly loan payment. He is tied to a predictable paycheck because he has a predictable liability. That small fee does not look dangerous until it shows up in his career choices. Maybe David stays in a job he hates for 2 extra years because he needs the stability to cover his debt. Maybe he skips starting a business because the risk feels too high. Sarah doesn't have that problem. Because she has zero debt, she has ultimate flexibility. She can take a lower-paying job she loves. She can move to a new city. Her monthly overhead is incredibly low, but there is a psychological trap for Sarah, too. It is called lifestyle inflation. When Sarah paid off her debt at year 5, she suddenly had hundreds of extra dollars in her checking account every month. The plan was to invest it. But human nature is tricky. Without the pressure of the debt, she feels rich. She upgrades her apartment. She buys a nicer car. She starts taking better vacations. Because the pain of the debt is gone, the urgency to save disappears with it. She meant to invest that $500, but most months she only invests $200. David doesn't have that temptation. His money is automatically pulled into his investment account before he even sees it, and his loan payment is non-negotiable. His debt is actually forcing him to be disciplined. The real cost of debt is emotional, but the real cost of paying it off early is time. And time is the one thing Sarah can never buy back. Let's fast forward. It is year 20. The dust has settled. Both Sarah and David have been out of debt for a long time. They are both in their early 40s, and they are looking at their net worth. Sarah paid off her debt in 5 years. For the next 15 years, she took that exact same $500 a month and invested it in the stock market. She was disciplined. She did everything right. Her portfolio, growing at an average of 8%, is now worth about $173,000. That is a huge achievement. Sarah is wealthy, secure, and proud of her choices. But then we look at David. David took the full 10 years to pay off his student loans. He paid thousands of dollars more in interest to the bank, but for those entire 20 years, he never stopped investing his $500 a month. Because his money had 20 full years to compound. Instead of just 15, his portfolio is now worth over $294,000. Even after subtracting the extra interest he paid on his loans, David is ahead by more than $100,000. $100,000. That is not a small difference. That is a decade of retirement. That is a paid-off house in some cities. That is a college fund for 2 kids. Sarah worked just as hard as David. She spent the exact same amount of money out of her paycheck every single month. She didn't buy designer clothes or waste money on expensive cars. She made the responsible choice. But the math of compound interest is ruthless. The money you invest in your 20s is worth exponentially more than the money you invest in your 30s. By rushing to pay off a low-interest loan, Sarah traded the most valuable investing years of her life for a feeling of relief. David tolerated the discomfort of debt, and the scoreboard rewarded him with 6 figures. I would be lying if I said investing is always the smarter move. There are situations where David's strategy will completely destroy your finances. The math only works if the interest rate on your debt is significantly lower than your expected investment return. We used a 6% student loan in this example. But what if Sarah and David had credit card debt instead? The average credit card interest rate is around 20%. There is no safe legal investment on the planet that consistently pays 20% a year. If you try to invest while carrying 20% credit card debt, you are trying to fill a bucket with a massive hole in the bottom. The math reverses. The debt compounds faster than the investments, and the bank wins every time. If your debt is above 8%, like a high-interest personal loan or a credit card, paying it off is the best investment you can possibly make. It is a guaranteed, tax-free return. And there is one more catch. The entire invest instead of pay off debt strategy relies on one massive assumption that you actually invest the money. If David decides to make minimum payments on his student loans, but instead of investing the extra $500, he uses it to lease a nicer car or eat at expensive restaurants, he loses. He ends up with a decade of debt, thousands in interest, and zero assets. The math changes if your situation changes. But if you have discipline, the numbers do not lie. Sarah and David both walked into adulthood thinking they were making the smart play. Sarah thought she was buying safety. David thought he was buying time. The real trap is not debt itself. The real trap is letting the emotional fear of debt blind you to the mathematical reality of time. When you rush to pay off low-interest debt, you feel like you are moving forward. But you are actually pulling your money out of the greatest wealth-building machine in history, just to buy a feeling of relief. The monthly payment is just the opening scene. The real story is what happens after. So the next time you have extra money and you are tempted to throw it at a low-interest loan just to make it disappear, ask yourself one question. What does this feeling of relief actually cost me when it is all over?